In this lecture, we're going to go a little bit deeper into the different aspects of the international monetary system. We're going to talk about how it's changed from the days when we had something called the gold standard, and we're going to introduce something called the International Monetary Fund, an institution. And also, in the context of that, we're going to talk about how the IMF classifies different exchange rate regimes or different exchange rate systems throughout the world. Broadly, we can categorize these regimes into fixed versus flexible exchange rates, and we'll talk about what those are. We'll also talk about the euro, the creation of it, which is a common currency for a lot of Europe, and we'll talk about exchange rate systems for emerging market countries, countries that have had fast growth from a relatively smaller economic base. We'll also talk about the exchange rate strategy of China. For its currency, the yuan, also known as the renminbi, and how that strategy has changed over time. Let's start with the gold standard. This is a historical exchange rate system. Gold is probably the oldest currency out there, used as a exchange of value, trade for goods and services, since about 5,000 years ago. And in the 1800s up until the early 1900s, currencies, whether it's the French franc, the US dollar, or the British pound, they were all linked to a certain amount of gold. They were backed by gold. So each French franc could be converted, for example, to a certain amount of ounces of gold. And same with the dollar. Effectively, that way, if you knew the ratio of exchange of franc to gold, and you knew the ratio of exchange of US dollar to gold, then it followed that you knew the ratio of exchange of one currency to another. 5 francs could have bought 1 ounce of gold, and $10 could have bought 1 ounce of gold. So the ratio of the franc to the US dollar should be 1/2. Half a franc buys 1 US dollar. Or, if you want to say it's the other way, using 1/x, 1 franc buys 2 US dollar. So this is it. Since each currency was fixed to the rate of gold, then currencies were effectively fixed to each other. That's the classical gold standard period. However, after that period, war broke out, and there wasn't much coordination between countries. This type of exchange required coordination, and that coordination broke down upon fighting. This is a first period in which currencies effectively began to float. That is, the rate of exchange was not linked to the price of gold, but instead fluctuated. The demand for that currency changed the price that people were willing to pay, and the price changed day to day. That's a floating exchange rate system. After the war ended, coordination began to occur again, and we had a period of fixed exchange rates again. But for reasons that we'll discuss from the 70s onward, we've gone back to floating exchange rates for the most part. And today, we have a lot of floating exchange rates, but we have a lot of exchange rates that are somewhere in between fixed and floating. So after World War II, the US became a dominant economic power, and that was reflected in the dominance of its currency. After the tatters of World War II, the US and related countries built a new international monetary system. That took place at a place called Bretton Woods, and that location is where this institution called the IMF, or International Monetary Fund, was created. The IMF was initially created to help stabilize currencies, and they'd also help countries with economic problems that could be repaired through better economic policy. As a tool to help accomplish these two tasks, they created special drawing rights, or SDRs. Effectively, it's a weighted average or a basket of a bunch of different currencies. So after Bretton Woods, a system of fixed exchange rates went into play. And effectively, it was like it was before, but with one key difference. The US dollar was linked to the price of gold, fixed. But then the other currencies were fixed to the US dollar. In this way, it's just like we were looking at before. Effectively, if the US dollar is fixed to the price of gold, and British pound is fixed to the US dollar, yen is fixed to the US dollar, franc is fixed to the US dollar, then the rate at which the British pound can be exchanged for yen is also fixed. Likewise for the yen to the franc, and so on. This system worked for a while, but eventually it fell apart. And the reason is complex, but basically all these countries, which were initially decimated by World War II, ended up growing faster, in some cases much faster, than the United States. Demand for these currencies hence also grew faster during this time relative to the US dollar, and that put pressure on this exchange rate. Eventually, this led to a lack of confidence in the US dollar in the 1970s, and it led to a devaluation, a weakening of the rate of exchange of the US dollar for the amount of gold. Roughly, the price of US dollars gold was about $25 before the devaluation, but then after the devaluation, it took $52 to buy the same amount of gold, a weaker US currency. But even that wasn't enough. And eventually, the US dollar just became completely floating. And as a consequence, these currencies started floating too. Currencies, in other words, started to move up and down in price, determined by market forces. That began in 1970, and really it's been going on since, not just 1997. It's just that 1997 and onward is a new era. Here we have even more complexity because of emerging market economies, and most notably including China. So, here's kind of where we're at today. You do have currencies that have something called a hard peg, and this is like a super fixed exchange rate. But on the other end of the spectrum, you have currencies that are completely floating. They are driven completely by whatever the market thinks it's worth. And then you have countries in between that have soft pegs. These countries may allow their currency to float and be determined by market forces, but if they ever jump up too high, the government will intervene to make sure that that doesn't happen again. So with a soft peg, countries allow their currencies to float, but only within a certain range. This is nice because it doesn't require too much action on behalf of the country managing the currency, but they will still intervene to avoid extreme fluctuations. And that makes it more attractive for people that want to deal with that country's exports, to buy in that currency, to sell in that currency. It's easier to buy and sell, more attractive to trade in that currency if you have a sort of range of what that currency will go up and down by. You can even have something called a crawling peg. This is where the price of one currency is linked to another, but it's allowed to generally trade and change over time. And so again, while it's allowed to fluctuate within a defined range, over time, it may be allowed to appreciate, that is, increase, or depreciate, decrease, against another currency in value. So when it comes to fixed or floating, there are really many different gradations of that. On one extreme, you have a hard peg, where it's completely fixed to another currency. At the other end, a currency can be completely free-floating, where government never intervenes to affect the value of that currency. The US dollar is an example of a free-floating currency. The Hong Kong dollar, as of the time of this recording, is an example of a hard peg. It's linked completely to the value of the US dollar and doesn't fluctuate. In between this spectrum, You have many different types. Of those countries that have IMF membership, which are most countries, about 34% of them have a floating exchange rate. That's what you see in light blue here. But almost an equal number have a soft peg. That is, they allow their currencies to fluctuate somewhat, but it's linked in value to another currency and not allowed to deviate too much from that. A relative minority have a hard peg, meaning that their currency doesn't change at all in relation to another currency. That's a very expensive thing to do, have a hard peg. Over the course of these lectures, we'll find out why that's expensive. So we see many different countries have many different choices of exchange rates. Why do they have all these differences in choice? The answer is that having different exchange rate regimes, the choice of having one regime versus another depends on these different characteristics of your country. If interest rate levels are more important to you, you may want to choose a floating exchange rate for reasons that we'll see. For other countries that want to promote economic growth through exports and have a positive trade balance, they may better accomplish that by having a fixed or a pegged exchange rate or semi-pegged exchange rate. And as country policies change over time, so will their exchange rate regime. In general, it's desirous to have a fixed exchange rate regime because you'll then have stable prices. As mentioned previously, if you have a country with a fixed exchange rate, it's very predictable to do business with firms in that country. You know, if you have to buy, say, 1,000 tires from a country with a fixed exchange rate, if you buy 1,000 tires from them, you have to pay in their currency. And if I'm going to buy tires 6, 12, 18 months from now, that's one less element of predictability I have to think about, because at least I don't have to predict what the value of that currency is going to be. Let's take this example. If I know that I can buy tires 6 months from now from my supplier in Japan for 10,000 yen a tire, and again, in 24 months, because I have good relationships with this supplier, I know that I can still purchase for that same amount of yen, the same amount of tire. Then if I know the exchange rate today, perhaps $1 buys 100 yen, then I know how much it's going to cost me in US dollars. $100 a tire. However, this assumes that the exchange rate is fixed, that in 6 months, the exchange rate is 100 yen to the dollar, and that in 24 months, the exchange rate is still 100 yen to the dollar. But if exchange rates are floating, that is, they could change at any time, and perhaps in 6 months they're 100 yen to the dollar, but they're 90 yen to the dollar in 24 months, then that same tire, even though my supplier didn't increase the cost in yen terms, but since I'm translating my US dollars into yen to be able to purchase those in 24 months, and because now in 24 months, $1 buys fewer yen, then the cost to me has risen relative to 6 months. And this is the exchange rate uncertainty that businesses face when doing international business. You may have the same price for an export that you're purchasing, and yet, because of exchange rate fluctuations, the effective cost to you changes. And so this is one reason why countries prefer fixed or stable exchange rate regimes, because you can have stability in international prices. Have stability in international prices, you'll have stability and increased international trade. However, it's very expensive to have a fixed exchange rate regime. It's something that the government of that country has to actively get involved in. That's because they need to intervene in the market to manage the value of their currency. Central banks of that country, the central bank of that country. In the US, that's the Federal Reserve, but other countries have their own central banks. The managing country and its central bank will need to maintain large quantities of other currencies in order to keep that exchange rate fixed. And moreover, Even if you have a currency that is kept fixed by the government or close to being fixed, the problem is that your fundamental economics, the country's economic fundamentals, may change over time, so that the condition of the country is not really representative of the condition of the currency. And this can lead to imbalances, distortions in the economics of the country. And so there are undoubtedly trade-offs when a country selects a fixed exchange rate versus a floating exchange rate. These trade-offs are reflected in something called the impossible trinity. Ideally, you'd like to have exchange rate stability, but you'd also like to have lots of money flowing in and out of your country, because that facilitates trade and investment. And at the same time, you want your central bank to have something called monetary independence. You want it to be able to take actions that it needs to support the economy. But having all three of these at once is actually quite impossible. Check out the handout on iLearn for a more detailed discussion of this, but the basic idea is this. One way to keep an exchange rate fixed for a country is to exercise greater control over its currency. If this is a country's financial border, then if lots of money started flowing in, people from outside the country started buying up the currency because they wanted to buy property or other assets that are located in this country, that will push up the value of that currency. All this buying pressure for that country's currency is going to increase the price of it. That means a problem for a fixed rate. How is the country going to keep a fixed exchange rate in that setting? One thing they can do is simply say, this is our border. This is our financial border. No money can come in. Certainly that would prevent the problem of the increasing price of the currency because nobody can buy it. But that could have a disastrous effect on that country's economic condition. This money that is now stopped was going towards investment in real estate and other financial assets. Without that investment, you don't have that economic growth. And so there's our trade-off between a fixed exchange rate and a free flow of capital in and out of the country. Now let's take a look at monetary policy. When a country wants to boost economic activity with monetary policy, it lowers interest rates. If you remember from corporate finance and capital budgeting, firms decide whether to invest in something or not, whether to undertake a business venture based on how profitable it is. In other words, the sum of its future cash flows. But remember that we discount those future cash flows by the discount rate. The Fed, when it uses monetary policy to boost economic activity, manages interest rates. They try to lower interest rates in the economy. They lower R. Do you remember from your corporate finance class what happens when you lower R to the present value? The answer is that the present value rises. The investment attractiveness of this different investment option that you're looking at increases, essentially because it's less risky or it's cheaper to finance. More companies, in other words, when interest rates fall, tend to find more profitable opportunities for investment, increasing or stimulating economic activity. That's the idea of monetary policy. But what does this do to a country's currency? Interest rates differ by country. If two interest rates between two countries are the same, though, then an investor should be kind of indifferent whether they buy buildings here in Japan, they buy buildings here in the United States. If they're expecting a 5% interest rate, consider this as like an expected return. Then they're kind of indifferent between being in the USA or being in Japan. But if interest rates fall in the United States, perhaps because of monetary policy, but they stay constant in Japan, there's a change in investor behavior. all of a sudden investors don't want to stay in the United States because the yield, the interest rate that they can get there, is lower than what they can get in Japan. The result is that they'll take their money, sell the US dollars, and then buy Japanese yen. This will boost the value of the Japanese yen against that of the dollar. And here's the crux of the problem. By having an independent monetary policy, by lowering interest rates, we've broken any hope for maintaining a fixed exchange rate. Our only hope in this scenario is to block the flow of capital outside of the United States. But that has its own side effects. So if we want to avoid those side effects, we can only keep these two. That is, we have to accept the fact that we can't have a fixed exchange rate in this scenario if we want a free flow of capital. This impossible trinity idea relates to our discussion of the euro. That's because Europe, many countries in Europe, about 27, have, over the last 30 years, built a single currency. And as a result of having a single currency, they've had to adopt a single central bank, the ECB. It took a lot of work to build this currency because all these different countries have different economic conditions. And so before actually starting the euro, it was required for all these joining countries to have similar level of economic conditions, to manage their inflation and interest rates, to manage or minimize their deficits, that is, the amount of government borrowing that they did, and to just gradually increase economic coordination between the various countries. This had benefits. When they created the euro, this meant that you didn't need to stop and exchange currency every time you visited a different European country. If you've ever gone through Europe on, say, a train trip, it's very easy to go from one country to another in a matter of hours. You can visit 4 countries within 6 hours. And think about how difficult that would be if every time you went through a new country, you'd have to exchange your currency from one to another. So as a result of having a single currency, the euro, transaction costs in the Eurozone were reduced significantly. And trade, as a result of having just a single currency to deal with and not the unpredictability of many, was also increased. We can see the value of the euro against the US dollar over an approximately 20-year time period. Note that what we're looking at here is US dollars per euro. So this 1.6 here means that 1 euro buys 1.6 US dollars. And so as 1 euro buys more US dollars, that means the euro is getting stronger. The euro has appreciated since its introduction in 1999. When we talk about something called a currency board, we're moving beyond to a different region of the world. There are a few countries that have a currency board. Hong Kong is one of them. For a while, Argentina had one as well. Basically, it means that if you have a supply of that country's currency, that supply must be matched by a supply of the currency which you're pegging to. That country's central bank must hold an equivalent amount of USD for every single peso that is out there. If a country wants to increase its supply of pesos in circulation, then the only way to do that, while still preserving the value of the pesos against the US dollar, is to buy and hold an equivalent amount of US dollars. That's a currency peg. It's relatively rare because it's expensive. You have to hold an equivalent number of dollars, or whatever currency you're pegging to, for every unit of currency that you've got out in distribution in your country. A few countries even do dollarization. That's basically where they abandon their own currency and just use US dollars. Panama and Ecuador are just 2 of the few examples that go this route. Emerging market currencies face special issues. One is that the emerging market countries tend to have sudden stoppages and flows out of capital, foreign capital. When global instability occurs, it tends to be that foreign investors take their money out of those emerging market countries very quickly. The net effect is selling that country's currency to buy up other assets, to buy up other currencies so that they can buy other assets in other countries. And the net effect is a rapid depreciation in that country's currency. Common problem for emerging market currencies. Another issue that we see in certain emerging markets is the weakness of a monetary institution. What that means by weakness is that it tends to be overly influenced by political officials. Ideally, what you want in a central bank is really just professionalism. If they are supposed to manage a country's currency versus that of another currency, then they should just focus on that. Or if they are really just there to manage interest rates, keep them low if the economy is not doing well, but raise them if the economy is growing too fast for its own good, that's what a central bank should be there for. But if a central bank is weak, what that means is that politicians tend to intervene to tell the central bank what to do. And often these interventions are there for political reasons as well. A politician, for example, might tell the central bank to lower interest rates because an election is coming soon, not necessarily because it's good for the long-run health of the country, or vice versa. They might tell them to stop raising rates because that can cause a slower economic activity, even if it's better in the long run. Again, because perhaps they want to win the next election. In countries with long economic history, with a history of developed capital markets, it tends to be that the monetary institutions are separate from the political institutions. But in countries that are still sort of finding their feet from a political and economic structure sense, monetary institutions and political institutions are still too closely intermingled, and it leads to these problems. China is not necessarily one of these countries. Although it is an emerging market country, and although it is true that the central government has very strong control over the central bank, the coordination there is still good. Gradually, what we've seen is the RMB, the Chinese yuan or the renminbi, gradually increase in value against the US dollar as a result, or consistent with, China's rise as an economic power. Over time, during this rise, the Chinese central bank, the People's Bank of China, has kept that rise within a certain bound or trajectory, not letting the currency become too volatile against the US dollar. So they've allowed the currency to adjust to the changing economic circumstances, but they've also minimized the day-to-day volatility or uncertainty in that currency. If you remember from just a bit ago, that's called a crawling peg. Here you can see the impact of a fixed exchange rate. But gradually, $1 has bought fewer and fewer Chinese yuan over time, a weakening of the dollar or a strengthening of the Chinese yuan.